Hello everyone, and welcome back to the Canadian Real Estate and Mortgage channel. Today's video, we will be covering how to prepare to get a mortgage. Before we start shopping around for a mortgage, it's important to assess your financial situation. There are actions that you can take to make sure that you're financially ready to buy a home. So, let's get into it. Number 1, check your credit report. A potential lender will look at your credit report before approving you for a mortgage. Before you start shopping around for a mortgage, order a copy of your credit report. Make sure it doesn't contain any errors. If you don't have a good credit score, the mortgage lender may refuse to approve your mortgage, decide to approve your mortgage for a lower amount or at a higher interest rate. Only consider your application if you have a large down payment, require that someone co-sign with you on the mortgage, or require that you get a mortgage loan insurance even if you have a down payment of 20% or more. The second thing that you can do is stay within your budget. To qualify for a mortgage, you have to prove to your lender that you can afford the amount that you're asking for. Mortgage lenders and mortgage brokers use your financial information to calculate your monthly housing costs and total debt load. They use this information to determine what you can afford. Lenders and brokers consider information such as your income before taxes, your expenses, including utilities and living costs, the amount you're borrowing, your debts, your credit report and credit score, and the amortization period. They also look at your total monthly housing costs. Your total monthly housing cost should not be more than 39% of your gross household income. This percentage is also known as the gross debt service ratio. You may qualify for a mortgage even if your GDS ratio is slightly higher. A higher GDS ratio means that you're increasing the risk of taking on more debt than you can afford. Your monthly housing costs include mortgage payments, property taxes, heating, 50% of condo fees, if applicable. Total debt load. Your total debt load should not be more than 44% of your gross income. This includes your total monthly housing costs plus all of your other debts. This percentage is known as the total debt service ratio, TDS. You may still qualify for a mortgage if your TDS ratio is slightly higher. A higher TDS ratio means you're increasing the risk of taking on more debt than you can afford. Other debts may include your monthly payments for your credit card balances, car loans, lines of credit, student loans, child or spousal support, or any other debts. Finally, how the stress test can impact your qualification. Federally regulated entities like banks require that you pass a stress test to get a mortgage. This means that you need to prove that you can afford payments at a qualifying interest rate. This rate is typically higher than the actual rate in your mortgage contract. You need to pass this stress test even if you don't need mortgage loan insurance. Credit unions and other lenders that aren't federally regulated may also ask you to pass the mortgage stress test. The bank may use the higher interest rate of either 5.25% or the interest rate that you negotiate with your lender plus 2%. If you already have a mortgage, you'll need to pass the stress test if you want to refinance your home, switch to a new lender, or take out a home equity line of credit. So there you have it. These are the things that you should be doing when you're preparing to get a mortgage. If you like this type of content, be sure to like the video, subscribe to the channel, and share it with whoever you can.